Hi everyone, this is Victor here. In this video, I'm going to analyze Amazon stock to see if it's greatly undervalued now. At the time of making this video, Nasdaq is in a large correction. Nasdaq has dropped 22% from its most recent peak. Amazon stock has dropped 24% from its most recent peak. Amazon is one of the best performing stocks in the past 5 years, outperforming the Nasdaq by a large margin during this period. Obviously, past performance does not guarantee future results. So in this video, I'm going to analyze Amazon stock to see if it's still an outstanding business to invest in for the long term. I will cover these topics: Amazon's 24-1 stock split and 10 billion share buyback, what you need to know, Amazon's business overview and revenue guidance, Amazon's large economic moat and long-term prospects, Amazon's two main risks you should know, Amazon stock valuation. You'll learn about how to calculate Amazon's intrinsic value per share, and will I buy Amazon stock? If you like this video, make sure to hit the like button, subscribe and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we will be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. Recently, Amazon announced that its board of directors has approved a 24-1 stock split. The company also announced its plan to buy back up to 10 billion worth of Amazon shares. So what does this mean to retail investors? Let's say you own one Amazon share. A 24-1 stock split means you will receive 19 additional Amazon shares for each Amazon share you own. If Amazon is traded at $2,900 per share, Amazon will change from $2,900 per share to $145 per share after the 24-1 stock split. A 24-1 stock split benefits retail investors because it will make each Amazon share more affordable and cheaper to buy. The stock split will also increase Amazon stock's liquidity in the market, so it will be easier for investors to buy and sell Amazon stock. Here's the important part about the stock split. The 24-1 stock split does not change Amazon's business fundamentals. The stock split does not change Amazon's intrinsic business value. Amazon's business is still the same. Amazon also announced that the company will buy back up to 10 billion worth of shares. According to Reuters, the stock buyback replaces the previous 5 billion stock repurchase authorized by Amazon's board in 2016, under which the company had repurchased 2.12 billion of its shares. Before investing in any stocks, I believe it's very important to understand the business first. Amazon has many businesses. Its main businesses are Amazon online stores that sell both Amazon first-party products and third-party sellers' products, fulfillment by Amazon FBA services for third-party sellers, physical stores such as Whole Foods, subscription services such as Amazon Prime membership and Prime Video, advertising services for third-party sellers, and Amazon Web Services (AWS). AWS is the largest infrastructure as a service, IaaS, and platform as a service (PaaS) cloud provider in the world. The important question is this: how profitable are Amazon's businesses? This is from the most recent Q4 2021 earnings release. If you look at this here, Amazon has separated its total sales into different businesses: online stores, physical stores, third-party seller services, subscription services, advertising services, and AWS. Online stores, third-party seller services, and AWS earn the most revenues for Amazon. Even though Amazon earns the most revenues from online stores and third-party services, AWS is much more profitable than all other Amazon businesses. For example, in fiscal 2021, Amazon's total operating income was 24.9 billion. AWS earned the largest operating income of 18.5 billion. In comparison, the North America business segment had an operating income of 7.3 billion, and its international business segment had an operating loss of 924 million. This shows most of Amazon's total operating income is from AWS. AWS also has a much higher growth rate than Amazon's online stores, third-party services, and all other services. For example, in the recent quarter, AWS net sales grew 40% year over year. In comparison, Amazon's online stores net sales decreased 1% year over year, and third-party seller services net sales grew 11% year over year. Amazon also earns revenues from subscription services such as Prime membership and advertising services from selling ads to third-party sellers. Prime membership is the biggest revenue contributor for subscription services. At the time of making this video, Amazon already has over 200 million Prime members around the world. Amazon's Prime membership has been growing consistently every year for many years already. Most people sign up for Amazon Prime because they always shop on Amazon and because they like Amazon's free same-day and next-day shipping service. I will talk more about this later. According to Morningstar, you can see Amazon had very consistent revenue growth, very consistent operating growth, and consistent operating cash flow growth in the past 10 years. However, Amazon does not have very consistent free cash flow yet because Amazon has very large capital expenditures, capex, each year. Amazon still needs to reinvest a large amount of capital into AWS, fulfillment centers, warehouses, shipping services, and logistics each year. In recent quarters, Amazon have been spending a lot more capital to expand its IT infrastructures, warehouses, transportation capacity, logistics, and AWS. This is why Amazon had a large negative free cash flow in fiscal 2021. Management gave this revenue guidance for the next Q1 2022 quarter. Net sales are expected to go between 112 billion and 117 billion, or to go between 3% and 8% compared with first quarter 2021. Operating income is expected to be between 3 billion and 6 billion, compared with 8.9 billion in the first quarter 2021. This revenue guidance shows Amazon's revenue growth is likely decelerating and the company's operating income will likely be lower in 2022 because of high operating costs, higher inflation rate, higher salaries for employees, supply chain issues, and large investments in fulfillment centers, logistics, IT infrastructures, and AWS. Another thing I should mention is this. In the recent Q4 quarter, Amazon beat earnings estimates by a large margin because Amazon reported a one-time 11.8 billion valuation gain from Rivian when Rivian went public. In my opinion, this large earnings beat is very misleading because the 11.8 billion valuation gain from Rivian stock is only a one-time item. This is an unrealized gain because based on what I know, Amazon likely did not sell Rivian stock. This 11.8 billion valuation gain is not real income from Amazon's operating businesses. Here is the problem in the upcoming quarters. Amazon will likely need to report a large valuation loss in Rivian stock in the upcoming quarters, even if Amazon does not sell Rivian stock, because Rivian stock has dropped around 80% from the most recent peak since its IPO. Let's talk about Amazon's large economic moats and long-term prospects. I believe Amazon's most important business, AWS, has a very large economic moat and excellent long-term prospects. This is from the most recent Q4 earnings call. It shows AWS has excellent long-term growth prospects and a high growth rate. Management said AWS saw a continuation of the strong usage and revenue growth we have seen through 2021. AWS added more revenue year over year than any quarter in its history, and it's now a 71 billion annualized run rate business, up from 51 billion run rate 1 year ago. In the past quarter alone, Nasdaq announced a multi-year partnership to migrate North American markets to AWS, including the matching engine. Best Buy selected AWS as its preferred cloud provider for cloud infrastructure services. Meta, the parent company of Facebook, Instagram, and WhatsApp, selected AWS as its long-term strategic cloud provider to accelerate artificial intelligence research and development. But where we sit now, AWS has 84 availability zones in 26 regions around the world right now. And just in terms of the forward-looking roadmap, we have announced to launch 24 more zones in 8 more regions, and those will have in the next couple of years. According to Gartner, Amazon Web Services (AWS) is the market leader in Infrastructure as a Service (IaaS) and Integrated Platform as a Service (PaaS). AWS has been the market leader in cloud computing services, especially IaaS and PaaS, for many years already. For example, according to Synergy Research Group, you can see Amazon's AWS market share has been very constant at 32% to 33% for many quarters. AWS' two biggest competitors are Microsoft Azure and Google Cloud. This is from Canalys. You can see that worldwide spending on cloud infrastructure services has been growing very consistently in recent years because many large enterprises around the world have been migrating their IT infrastructures from traditional on-premise data centers to the cloud. The pandemic has accelerated many businesses' migration from on-premise data centers to the cloud because cloud computing is much cheaper, much more scalable, and oftentimes much more reliable and secure than the traditional on-premise data centers. Also, e-commerce, online gaming, video streaming, video conferencing, working from home, and now the metaverse have pushed many companies around the world to invest much more in cloud computing going forward. Since many large businesses are moving to the cloud, most of them would choose the largest and most well-established cloud providers. And the best cloud providers are Amazon AWS, Microsoft Azure, and Google Cloud. In my opinion, it's almost impossible for other companies to compete with Amazon AWS, Microsoft Azure, and Google Cloud because these three largest cloud providers are already far ahead and well-established in infrastructure as a service and integrated platform platform as a service. The closest competitor is Alibaba Cloud, but Alibaba Cloud mainly operates in China. Going forward, I expect AWS will continue to be the biggest profit driver for Amazon for many years because AWS is already the dominant leader in infrastructure as a service and integrated platform as a service. AWS is also much more profitable than all other Amazon businesses. I believe Amazon's online stores business also has a very large economic moat, but its revenue growth should be much lower than AWS revenue growth. The main reason is that Amazon's e-commerce business is much more mature in North America. Management expects Amazon's total net sales to grow between $112 billion and $117 billion, or to grow between 3% and 8% compared with first quarter 2021. Amazon's online stores and third-party seller services contribute the most sales compared to AWS. The 3 to 8% expected net sales growth shows Amazon's e-commerce business, including both online stores and third-party seller services, will likely have a much lower revenue growth rate going forward, at least in the short term. In the short term, I believe Amazon's operating income will likely drop in 2022 compared to 2021 because of the current high inflation rate, higher salary costs, higher shipping costs, supply chain issues around the world, and much higher investments in fulfillment centers, Amazon Logistics, and most importantly AWS. This is why management gave a much lower operating income guidance, even though Amazon's total net sales are expected to grow between 3% and 8% in the upcoming quarter. Management said operating income is expected to be between $3 billion and $6 billion, compared with $8.9 billion in the first quarter 2021. In the long term, I expect Amazon's e-commerce business will continue to grow for many years because consumers will continue to shop online using Amazon. This is from eMarketer research. eMarketer forecasts that the worldwide retail e-commerce sales will continue to grow between now and 2025. You can see the red line here showing the expected e-commerce sales growth rate between now and 2025. Amazon's biggest economic moat is this. Amazon's online store is already the largest online retailer in North America and in many countries around the world. Like Google, Amazon is essentially an online search engine for consumers to search the products and digital content they want to buy. In North America, most people tend to use Amazon first before using Walmart, eBay, or other online retailers and marketplaces because Amazon usually has the largest selection of products at very reasonable prices. More importantly, Amazon has very fast shipping services such as same-day shipping, one-day shipping, or two-day shipping. If you're an Amazon Prime member, you will have free same-day, one-day, or two-day delivery on millions of products. Other benefits include Prime Video, Prime Music, and discounts on Amazon Prime Day every year. This is why Prime members have been growing consistently for many years. At the time of making this video, there are over 200 million Prime members around the world. In my opinion, it will be very hard for other competitors to copy Amazon's business model. Large selection of products at very reasonable prices, fulfillment centers, warehouses, logistics, Prime membership, and same-day or next-day shipping services. This is why I believe Amazon's e-commerce business and Prime membership will continue to grow for many years. Let's talk about Amazon's biggest risk. I believe Amazon's first biggest short-term risk is higher operating costs going forward. That will reduce Amazon's operating income and free cash flow growth. For example, in the most recent Q4 quarter, Amazon's North America business segment had an operating loss of $206 million, and it was down 107% year over year. Amazon's international market business segment also had an operating loss of $1.6 billion, and it was down 549% year over year. Only AWS had an operating income of $5.3 billion, and it grew 48% year over year. This means all of Amazon's operating income came from AWS in the most recent Q4 quarter. Amazon's operating costs have increased a lot in recent quarters because of supply chain issues, much higher inflation in the US and in many countries around the world, higher salary costs, higher shipping costs, high inventory costs, labor shortage, and much higher capital expenditures to invest in AWS, IT infrastructures, fulfillment centers, warehouses, shipping, and Amazon Logistics around the world. Management said this in the recent earnings call. As we mentioned in the last earnings call, we did see more than $4 billion costs from inflationary pressures and lost productivity and disruption in our operations. The inflation primarily relates to wage increases and incentives in our operations, as well as higher pricing from third-party carriers supporting our fulfillment network. Productivity across our fulfillment network currently is being affected by global supply chain constraints and constrained labor markets, which increase payroll costs and make it difficult to hire, train, and deploy a sufficient number of people to operate our fulfillment network. Going forward, Amazon may have lower operating income in 2022 and even 2023 compared to 2021 because of higher operating costs, higher inflation rate, and supply chain issues around the world. I believe Amazon's second biggest risk is antitrust issues. For example, according to CNBC, the DC Attorney General is filing a complaint against Amazon for enforcing policies that prevent Amazon third-party sellers from selling products at a lower price at other competing marketplaces. Also, according to CNBC, the DC Attorney General is alleging that Amazon's minimum margin agreement with first-party sellers has the practical effect of incentivizing those wholesalers to raise their prices for marketplaces outside of Amazon. That's because those agreements require that the wholesaler guarantee Amazon a minimum profit, meaning the seller must make up the difference if it doesn't match that margin. We're seeing alleged first-party sellers may be inclined to raise their prices elsewhere to ensure that Amazon does not drop its price based on lower prices elsewhere. These agreements reduce other online marketplaces' ability to compete with Amazon by offering lower prices to consumers. According to the complaint, which goes on to say that the practice results in reduced competition among online marketplaces and higher prices to consumers. In my opinion, Amazon is a near monopoly in the e-commerce market in North America. If these antitrust regulators find Amazon is practicing anti-competitive behaviors, Amazon will likely receive large fines going forward, similar to Google and Microsoft in the past. Let's talk about Amazon stock valuation. I always use this intrinsic value calculator to calculate a stock's fair intrinsic value, so I will know whether the stock is undervalued, fairly valued, or overvalued now. If you want this calculator, you can download it in my Patreon blog in the video description. We are not using a discounted cash flow DCF model to value Amazon's intrinsic value because Amazon does not have consistent free cash flow growth yet. Amazon has many businesses, so we will use the sum of the parts valuation model to calculate Amazon's intrinsic value. Amazon's major businesses are Amazon's online stores and physical stores, Amazon's third-party seller services, subscription services, advertising services, and AWS. For the first businesses, Amazon's online stores and physical stores, I have added their trailing 12 months of revenue, which is $239 billion. The two comparable companies are Walmart and JD.com. The average price to sales PS ratio is 0.79. If we multiply $239 billion of revenue here by the average PS ratio of 0.79, the combined fair value is $189 billion. For Amazon's third-party seller services, the trailing 12 months of revenue is $103 billion. The two comparable companies are eBay and Alibaba. The average price to sales PS ratio is 6.59. If we multiply $103 billion of revenue here by the average PS ratio of 6.59, the fair value is $681 billion. For Amazon subscription services, the trailing 12 months of revenue is $32 billion. The two comparable companies are Netflix and Spotify. The average price to sales PS ratio is 5.7. If we multiply $32 billion of revenue here by the average PS ratio of 5.7, the fair value is $181 billion. For Amazon's advertising services, the trailing 12 months of revenue is $31 billion. The two comparable companies are Alphabet and Facebook. The average price to sales PS ratio is 8.55. If we multiply $31 billion of revenue here by the average PS ratio of 8.55, the fair value is around $266 billion. For Amazon's AWS business, the trailing 12 months of revenue is $62 billion. The two comparable companies are Microsoft and Oracle. The average price to sales PS ratio is 7.31. If we multiply $62 billion of revenue here by the average PS ratio of 7.31, the fair value is around $454 billion. At the time of making this video, Amazon has $96 billion of cash equivalents and marketable securities and $270 billion of short-term and long-term debts. The net cash is negative $174 billion. If we add all these businesses' fair values together, with Amazon's negative net cash here, Amazon's intrinsic value should be approximately $1.6 trillion for the entire company. Its intrinsic value should be around $3,095 per share before the 20-for-1 stock split. In comparison, Morningstar gave a much higher fair valuation of $4,100 per share. This means I believe Amazon stock is slightly undervalued at the time of making this video. So will I buy Amazon stock? Yes, I will continue to buy more Amazon stock when it becomes more undervalued because I like AWS large economic moat and its long-term growth prospects. I already have had Amazon stock in my portfolio for several years already. Personally, I want to have at least a 10% margin of safety before buying more Amazon shares. This means I will wait until Amazon drops at least 10% below its intrinsic value before buying the stock. Based on my estimates, I believe Amazon's intrinsic value should be around $1.6 trillion for the entire company and $3,095 per share before the upcoming 20-for-1 stock split. Every quarter, I will update Amazon's intrinsic value once the company releases its latest earnings. If you want the latest intrinsic value estimate for Amazon, you can download it in my Patreon blog in the video description. Now, all these estimates are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.